Stop. Before you buy real estate in 2026, watch this. Because right now, 9 American cities are in the middle of a real estate catastrophe. We're talking about markets where your $300,000 investment could be worth $210,000 in 2 years, where foreclosure rates are 3 times the national average, where families are fleeing faster than ever before. I'm going to show you the actual data that real estate agents don't want you to see. The numbers that prove certain cities are investment death traps right now. This isn't speculation. This is hard data from HUD, the Federal Reserve, and Zillow. Stay with me. This could literally save you hundreds of thousands of dollars. Look, the real estate market in 2026 is experiencing something unprecedented. While certain cities are thriving, places like Austin, Nashville, Phoenix, entire regions are experiencing what I call synchronized decline. That means it's not just about one bad neighborhood or a single economic shock. It's systemic collapse. Here's what's happening. Population is consolidating. Young professionals are moving to job centers. Manufacturing regions are hollowing out. And when people leave, real estate value evaporates. The data shows us something critical. The top-performing markets in America are experiencing price appreciation of 8 to 12%. Meanwhile, the worst markets are seeing declines of 18 to 31%. That's a 40-point spread. That's not normal. And here's the part that keeps me up at night. These declining markets are accelerating. It's not leveling off. It's getting worse. Which means if you buy in one of these cities thinking it can't go lower, you're probably wrong. Let me show you exactly which cities these are. Number 9, Toledo, Ohio. Toledo's situation is important because it shows you the early warning signs of real estate collapse. Population declining 2.1% annually. That doesn't sound catastrophic, but it's consistent. Year after year, people are leaving, but manufacturing jobs are gone. There's no economic engine anymore. The data shows price declines of 7.2% year over year. Inventory is piling up. Average time on market, 58 days. In healthy markets, that's 14 to 21 days. What this tells us is simple. Sellers are desperate, but buyers don't exist. When you're forced to drop prices, your equity vanishes. What's critical here is the trajectory. Toledo's problems are accelerating, not stabilizing. It's still in the early stages of decline, which means worse is coming. Toledo data, median home $142,000, price decline, minus 7.2%, population exodus, minus 2.1% annually, days on market, 58. Number 8, Stockton, California. Now here's the wild part. Stockton is in California. California, a state where real estate is typically golden. But Stockton is the exception. This is a city in crisis. What broke Stockton? The 2008 financial crisis hit it harder than almost anywhere else. People lost homes. Investors fled. And the city never recovered. Population is stagnant, basically flat for 15 years. But here's what's shocking. Even with a stagnant population, prices are falling. This tells us something crucial. When investor confidence collapses, even population stability doesn't save you. Stockton is down 11.8% in price. The city's general fund is constantly at risk. Schools are struggling. Crime is elevated. This creates a downward spiral. The real lesson from Stockton? Just because a state is generally good doesn't mean every city in it is safe. Stockton data. Median home $385,000, price decline, minus 11.8%, population trend, flat, crime rate, elevated. We're entering the serious collapse territory now. Number 7, Springfield, Illinois. Springfield is the state capital of Illinois, and it's imploding. Median home price, $167,000. Sounds reasonable, right? But here's the context. That price represents an 18.3% decline in just 18 months. That's a 36.6% annualized collapse. What caused it? Economic diversification failure. When state government can't support a city alone and private sector opportunities don't exist, you get Springfield. Population down 3.2%, unemployment up, property taxes increasing while services decline. This is the opposite of what makes real estate valuable. Springfield data. Median home $167,000, price decline, minus 18.3%, population, minus 3.2%, tax burden, rising. Number 6, Flint, Michigan. Flint is a name that's become synonymous with American urban decline. The lead water crisis, the manufacturing collapse, the desperate exodus. Population is down 55% since 2000, not 5.5%, 55%. When you see numbers like that, you have to understand what's happening. This isn't a recession. This is abandonment. Median home price in Flint, $79,800. Yes, under 80 grand. But that's not a deal. That's a signal that nobody wants to live there. Foreclosure rates in Flint are hitting 4.1 per 1,000 homes. That's 4 times the national average. This means distressed selling is creating a race to the bottom. If you buy hoping to flip it, you're competing against desperate foreclosure sales. You'll never make money. Flint data. Median home $79,800, price decline, minus 22.1%, population, minus 55% since 2000, foreclosure rate, 4.1 per 1,000. Number 5, Gary, Indiana. I have to slow down here because Gary represents the absolute worst-case scenario. This is what happens when a city completely loses its economic foundation. Population peak in 1980, 151,000. Current population, 69,000. That's 54% population loss in 44 years. Steel industry collapse, deindustrialization, economic devastation, and the real estate market reflects this perfectly. Median home price, $41,500. I want you to really understand what that number means. You can buy a house in Gary for the price of a used car. And it's still overpriced because people are literally giving up on the city. They're not even trying to sell, they're abandoning properties. Worst part? Vacancy rates are hitting 27%. Nearly 1 in 3 homes is empty. That's not a housing market. That's a ghost town. If you buy real estate here, you're betting on a resurrection that probably won't happen. And even if it does, it will take 30 years. Gary data. Median home $41,500, price decline, minus 31%, population, minus 54% since 1980, vacancy, 27%. The next 3 cities share something in common. They're experiencing accelerating population exodus, not slow decline, acceleration. Number 4, Hartford, Connecticut. Hartford is having an identity crisis. It used to be an insurance hub. That industry is consolidated now. Jobs left, people followed, population down 8.2% in 3 years. That's fast exodus. The housing market is collapsing alongside the population. Price decline, 22.7%. Median home price, $198,000, down from $255,000 just 36 months ago. Property taxes are crushing, among the highest in the nation. The city budget is in crisis. Schools are struggling. Here's the brutal equation. Population declining plus price declining plus tax burden rising equals investment disaster. If you buy in Hartford expecting gentrification, you're gambling against demographic trends. Hartford data. Median home $198,000, price decline, minus 22.7%, population, minus 8.2% in 3 years, property tax, very high. Number 3, Birmingham, Alabama. Birmingham has beautiful architecture and great bones, but the economy is broken. Unemployment, 6.1%, nearly a full point above national average. Population stagnant. Price decline, 8.3%. What makes Birmingham particularly dangerous is the invisible factor, brain drain. The educated young people are leaving. When that happens, future economic growth becomes impossible. You can't rebuild an economy without educated workers. This city is in a downward spiral that's hard to reverse. Rental vacancy rate, 11%. That means if you want rental income, you're competing for tenants that don't exist. Your cash flow assumption is broken. Birmingham data, median home $189,500, price decline, minus 8.3% unemployment, 6.1% rental vacancy, 11%. Number 2, Memphis, Tennessee. Memphis is experiencing something brutal: simultaneous crime surge and population loss. Population down 3.1%. Crime rates up 18% year over year. When you combine those two factors, you get real estate collapse. Price decline, 19.2% in just 18 months. Median price dropped from $285,000 to $230,000. If you were an investor who bought the peak thinking Memphis was the next Austin, you're now underwater by $55,000 per property. The psychological shift is important here. Memphis was being marketed hard by some real estate gurus as the next investment frontier. That narrative broke completely when crime data came out and more people left. Now it's being dumped by the same investors who promoted it. This teaches us something critical. If a market is being heavily promoted by influencers and gurus, that's often a sign it's near peak. When the data turns, they disappear. Memphis data, median home $230,000, price decline, minus 19.2%, population, minus 3.1%, crime surge, plus 18%. And the number one worst real estate market in America right now is one that's going to surprise you. Number 1, Las Vegas, Nevada. Las Vegas? The city every real estate podcast says is a buy and hold goldmine. The market with low taxes and cheap prices and population growth? That Las Vegas. Here's what happened. Las Vegas attracted thousands of real estate investors over the past 5 years. Syndicators raised billions in capital. New construction exploded, and now we're experiencing a supply tsunami. Data shows 34,000 new housing units coming online in the Vegas metro in 2026 alone. That's not normal supply. That's a supply shock. When you flood a market with new inventory, existing home values crater. It's basic economics. Investor returns have collapsed. Cash-on-cash returns that were 8.2% in 2022 are now 2.1%. That's a 74% decline in returns. When investor returns don't work, investor demand disappears. When investor demand disappears, prices follow. We're seeing 11% price declines right now. But here's what scares me. The worst isn't here yet. Once all 34,000 units come online, once the investor exodus accelerates, once prices fall another 15 to 20%, that's when we'll see the real pain. If you bought Vegas property expecting 8% returns and now you're getting 2%, you're basically getting savings account returns but with real estate risk. That equation doesn't work. Las Vegas data, new supply, 34,000 units, price decline, minus 11%, cash-on-cash returns, minus 74% from peak median home, $385,000 inch. Now, I promised you something surprising at the end. There's actually one city on this list showing early signs of recovery, and it's Gary, Indiana. Before you think I've lost my mind, hear me out. Gary is attracting young, entrepreneurial professionals who are priced out of Chicago. The median home price is so low that even with renovation, you're still cheap compared to nearby markets. Some forward-thinking investors are quietly buying, betting on a 20-year gentrification play. It's risky, but it's the only contrarian opportunity on this entire list. But here's what you need to know about all 9 of these markets. The common denominator is this: they all lack economic diversity. They all have weak job growth. They all experienced loss of faith from investors and residents. When people and money leave a city, real estate is the last thing to stabilize. If you want to invest in 2026, you need to understand this principle. Don't buy in cities people are leaving. buy in cities people are moving to. The winners in 2026 are Phoenix, Nashville, Austin, Denver, Atlanta. These are places where young professionals are concentrated, where jobs are growing, where rent and prices are appreciating together. That's where your money should be. Here's what I need you to remember. Real estate in 2026 is bifurcated. Winner-take-all markets on one side, collapse markets on the other. There's no middle ground anymore. If you're buying property, run the demographics. Check population trends. Understand job growth. Verify investor sentiment. Don't buy something just because it's cheap. Cheap is cheap for a reason. If you found this valuable, please like this video, subscribe. Thanks for watching. This video only for education purpose. I'll see you in the next one.